Hey, this is Albert Poggenstead. You came across my video to learn more about what the wheel strategy is. Some people call it the quad option strategy. Some people call it the wheel strategy. A lot of people in the industry just call it the wheel strategy or a way of just generating monthly cash flow in your stock portfolio. This is a management tool that you may or may not know about. There, it becomes so popular that they actually have funds that do this. But then again, you can also, with those exact same funds on what they use the wheel strategy for, you can put the wheel strategy on that also to gain even more. So it is a very interesting topic. I just want to take a few minutes just to talk about it. This is a systematic option trading approach designed to generate consistent income through the cash secure puts and cover calls. Yes, we're going to talk about options. They're not scary once you know how to manage them. This strategy is to acquire stocks at a discount while creating regular premium income. This is a very, very simple thing you can do. Anyone can do it that has a stock trading account. And this is so safe, they allow you to do it in your retirement fund. Now, your retirement fund has to be set up for you to pick the specific stock that you want to invest in. A lot of them, retirement funds like 401ks, they have certain accounts where you just, okay, here's my money, and then you tell them what your goals are, and they have somebody else trade that stuff, trade your money for you, and hopefully it comes out with a return. So this is just a way that you can take control of your own way of trading and how you want to generate monthly cash flow. And cash flow is king. I know you've probably heard the rich, what they try to buy assets that give them cash flow so they can afford other things. So we're going to just dive right into this and see what we can learn. If you have any questions at all at the end of this presentation, you're going to have my contact information. Just send me a quick email, and we can discuss more about this in the future. So understanding what the wheel strategy is, it's a cyclical process. You sell puts against until assigned shares, then sell calls until the shares get called away from you. So, what does that all mean? Well, it's really this simple. Let's say you have a stock that you want to buy. Let me grab a stock chart here real quick for you. Let's talk about Ford. Ford today is trading, or actually at the time of this recording was Friday, the last Friday, and this was at the end of the day. It was trading at $10.38. Well, maybe I don't want to buy that stock at $10.38. What I could do is sell a put option cash secured, which means I have to have that amount of money in if those stocks get assigned to me. And I put that order in for, I will buy Ford at $10. And that's just as easy as that. And then I collect a premium for that. And that depends on what the market is paying at that time. Remember, I am selling the option for those stocks to come to me at the price I want to pay. And then what I end up doing is once I get the stock into my account, I get to sell calls on that to rent it out to someone for a month, a week, a day, depends on what the option contract is for. So it's all up to you. This is a very flexible and easy way to generate cash flow. Income generation. Collect premiums for selling options regularly. This is where you can make this strategy work for you on your schedule. I travel a lot for work, and yes, I still work. One, I like it. Two, it keeps me busy. And three, it provides additional retirement income into my 401ks and other accounts so I can do the wheel strategy on it so I can keep growing and growing and growing my accounts. Because by the time I retire, I want to have a ton of shares of a stock. And when I have to start requiring to pull money off of that, do I want the number of shares to go down? No. Do I want my account to go down? No. I want to always go up, right? Just like everybody else does. But this is a way to generate monthly cash flow off of it, or weekly cash flow, or annual cash flow off of it. It all depends upon you. Next topic, there is cost-based reduction. Yes, over a period of time, you're going to start reducing your cost base of that, what you own that stock from. And as you know, we're going to get into the point where you can start seeing this really compound. We're going to take the law of compounding and start adding this to our investment portfolios. In the beginning, you get to buy that stock at a price you want. Then you get to, since you sold that option, you got ready to receive money for it, but you bought it at $10, like I said. Let's just say I received $1 for it. When I actually get it put to me, now my cost basis for that stock is $9 because I already got paid $1 to sell that put for that stock to get put to me. So I'm in for it at $9. Then I can sell call options on it to generate other income. And oh, by the way, if you Ford also pays a dividend. This is where you get to the point where it could call the quad strategy, because you can get to start to there's 4 ways to start making income off of this stock. One, stock could appreciate over time. It can do that. And then you get to buy it at the price that you want by selling a cover call or selling a put, cash secure put on it, which gives you income. And then you sell calls on it, which gives you income. So it keeps, as the more times you compound, the faster that compound starts building up, and you keep reinvesting that income into the investment. The more times you compound, or the faster you compound, the greater the snowball starts taking effect, and it gets larger and larger over time. As again, we talked about capital gains. Yes, you're going to have capital gains and appreciation over time, but if you do this in your 401k, depending on how you do it, depends on what type of tax advantages you have. Now, phase 1, cash secure puts. Sell the stock. Or correction, select a stock. When you select a stock, you pick one that you want to invest in, that you want to buy. Don't pick a trash stock or something that, oh, this is a very brand new hot stock. Pick something that you want to buy. A lot of people, well, I just don't know about the stock market. I don't understand it. Okay. Pick something that is, but you know the stock market, they always seem to know that the stock market is a good place to put your money, but they know nothing about it. And they also call it other things, like they think it's rigged and all that. Okay. What it does over a period of time, it usually goes up. Does it usually go up faster than the rate of inflation? No. There are certain parts of the stock market that doesn't allow to do it, that does not beat the rate of inflation. Some stocks don't do that. If you look at Ford, it doesn't beat the rate of inflation. But if you manage it using this wheel strategy, you can beat the rate of inflation. And if you're in a tax advantage account, you can really take advantage of this growth of this stock. So first of all, we're going to select a stock. Let's just select Ford. Now we're going to do sell a put option. Well, put option is a contract that you say that you will buy that specific stock at a specific price during a specific period of time. That you're willing to do that. But it has to be at or below that price. So going back to Ford again, let's say I want to, I'm willing to buy the Ford company here, the stock, and I want to I like it at $10.38, but I would really like it more if it was down at $10, because I like to get deals. So how do I figure out what I get for figuring out if I want to buy that stock? So I come down here to options, June 6th is the contract date. I'm going to come here and let's go down. The price is still at 1038. So we're going to the put side because we're doing cash secure put. Now, let's talk about the cash secure put. Well, a cash secure put is I have to have enough money in the account to cover the purchase of the stock because it is planned that you will receive the stock if it hits that price at or before that time frame. So by June 6th, if I wanted to do this right away, I would end up selling 100 shares. And I have to have enough money in the account to buy 100 shares. So for $10, 10 times 100 is $1,000. So I'm going to have to put in my trading account. They're going to carve it out of they're going to have it locked up while this contract is set in that I want to, because I'm going to sell this option for, looks like it's going to be 5 cents, the bid and the ask. We're going to purchase, we're going to sell. You always end up selling on the market. You're going to most likely sell on the bid price. So it's going to 5 cents. What's 5 times 100? Because that 5 cents, you get 5 cents per share. And I'm selling 100 shares. That's $5, which is not a lot of money. But think about it. They're going to pay me $5 to buy that stock at $10. But it's at 1038. Okay, so I save myself 38 cents and I get paid $5 to do that? That's awesome to me. Now you can scale this up. Different stocks have different prices. These are the option prices are a mathematical equation based on time, market sentiment. There's a whole bunch of things. I'm not going to get into that. That gets way too complicated. This is a management style on how to manage your portfolio. So let's just say I want to do that. I want to buy the stock, hopefully by the time of June 6th at this time of recording. This is in 2025. So that 5 cents is $5 for 100 shares. Okay. Now, if you do the math on that, let's do the math on that. Let's come over here, grab our trusted calculator real quick. 0.05 divided by $10 equals, you move the decimal point, it's 0.5%. Okay. It's not even that's not very much. Okay. But you got paid $5 to buy a stock 38 cents less than you would have got it at. So it comes to you. Sure, that's great. Now I can roll. We're going to finish up the cash secure puts first. Let's go back to those real quick. So you sell the put option. Remember, we're sellers of options. We're not buyers, we're sellers. There's a specific way you have to do that in your trading account, and we can talk about. You can contact me to talk about that, or you can just go online or ask your AI on how to do this. University of YouTube is great to learn this stuff. Option expires worthless. Okay, if the stock stays above the price that you get to keep the premium. That $5, you get to keep it, and you get to do it again and again and again until the stock gets put to you. No problem with that. If the stock falls below that strike price, you will automatically buy it at $10. Now this is where now if the stock dropped all the way down to 9, you still end up buying it at 10, and because you put in the contract to do that. So you're going to want to know or want to like that stock that you just purchased. I mean, like, not love, because we never fall in love with our own investments of those stocks. Okay, now let's go over to the next part. Phase 2. It's just sell cover calls. Now let's just say those calls those stocks got put to us. We have 100 shares that showed up in our stock portfolio. It's $1,000, and then we're going to sell cover calls options on it. Okay, this is we're going to use we're going to go to the real estate industry. So we just talked about cash secured puts, and we're going to also now we're going to the cover calls. Cash secured puts is kind of hard to relate to I can relate it to the real estate, but it's kind of difficult. We're going to talk about a general term on or general situation in the real estate business that most people know. So let's say that you own a house and you want to rent it out. That's what cover calls are. Plain and simple. Now, how long do you want to put the contract on for? That is up to you. If you ever notice when you go to try to rent an apartment, they try to put you under the longest contract as possible and lock you up in that price. That is true. That is, as a renter, you kind of want to be set up that way, right? Because you don't want to move all the time and you don't want to do all that. So you get this contract out for a year. So you know what your price is and you're there for a year. You have that contract. Well, there's other ways to rent that house out. It could be rented at a shorter period of time. Usually costs a little bit more, especially all the way down month to month. That means month to month is good for you, so you can leave right away. But it's also good for the landlord because they can increase the price of the rent at a faster pace than the normal once a year. Because if you put it underneath a contract for a year, it's 1 year and it's that price for that year. But as time gets shorter in that contract, meaning if you only do a 6 month, then they can raise the rent 6 months later. Or if you're on a month to month, the possibility of that rent going up is very much easier. So now just think about that when we talk about these cover calls. So selling cover calls. Now, you own the stock now, right? You just got it assigned to you, which is awesome. You got those 100 shares sitting in your account. And you want to sell an out of the money call option. Remember, we're selling, not buying. And there are specific terms and a specific way on how to do this in your account. But we can talk about those when you guys give me a call or go on YouTube, like I said earlier. So let's talk about what that would be. So how long do you want to rent this stock out for? Excuse me. You could do it. Let's say, hey, I want to rent it out for a full year. So what's a year from June 6th, 2025? Let's go to June 18th, 2026. Okay. How much did we buy the stock for? $10. What is our cost basis? 5 cents less than that, right? So it's $9.95. Now, what do you want to rent it out for? Remember, when we want to rent this stock out, do we want to keep it after we get done renting it, or do we want to sell it after we get done renting it? So that's two different things. What do you want to do? So let's just say you are wanting to rent it out for a year, because that's where we're at. 1 year from now, to do that, the contract is paying $1.50. Now that stock is going to be locked up for a year. They're going to have a year's period of time, a year from now, if that stock on that date is at or above $10.38, those stocks will be sold automatically at $10. Okay? So, but what's that percentage gain for you? Let's pull the calculator out again. Hit clear entry. So it said that we would receive $1.50 for this contract to sell over for a full year. This is a full year. So you're going to do this once, right? It took you Once you got the stocks to you and you want to only do work once a year, this is what you end up doing. So now we're going to take the quick math here real quick. $1.50 divided by 10 equals 15%. That's a great return, especially on a stock like Ford that doesn't move that much. Excuse me again. So you could rent it out at $10 or rent it out for $1.50 per share. So if you have 100 shares, that's $150. If you have more than those shares, okay, there's people out there that own 100,000 shares of Ford. And if they only want to work, let's do that math real quick. If they ended up they had $100,000 to invest in Ford at $10. Right? So $100,000. Let's do the math. They have $100,000 divided by 10 equals 10,000 shares. Okay, 10,000 shares. That means for 10,000 shares, how many contracts at? We have to divide that by 100. Divide that by 100. Equals 100, right? So that's 100 contracts. So, but we get paid, that contract pays out $1.50 for a year for 10,000 shares. So let's do that. 10,000 shares times 1.5. I know it's kind of easy math. It's $15,000. You worked for about just to do this setup. Takes you about 2 minutes to put this in your stock trade. And you make $15,000 for that year. That's 15% over the year. That's pretty decent cash flow if you had $100,000 just to put it into Ford. Now, has Ford been around a long time? Yes, that's great. What else I didn't tell you, if you go back to the summary of Ford, which I really want to, what an extra added bonus is, if you come down here, dividend yield. This is the Ford dividend yield, but the yield is at 7%. So, if you just made $15,000, which is 15% over that year, plus an extra 7% over that year, what type of gain did you get? You can do the math on that one. So let's go back to the presentation here real quick. So you're going to sell these cover calls. Option expires. Either the stock is at or below, if it's at or below the stock price at the end of the year, if it's below $10, you still get to keep the stock. And you get to keep the premium. And you get to keep the dividend because you own the stock. If you own the stock, you get the dividend. So now, if the stock is above the strike price, then it gets called. You end up selling that stock at $10. Okay. You had $100,000 willing to be invested into this stock of Ford, which is 10,000 shares. Now, if we go back to the trusty calculator, because I want you to really capture on how this happens. And I'm doing this with the longest, what's called a long call option that you sold. So let's just go from the beginning. Remember, with the cash secure put, and you had $100,000. I'm using this example. You can use 10,000. You just have to move the decimal point. So we had 10,000 shares, right? We wanted to buy 10,000 shares with the cash secure put. Let's bring that up again. Remind everybody what the cash secure put is. Where we select the stock, which we did was Ford. We're going to sell the put option, right? So the put option, bringing up Ford again. At that time, we're going to go back to options. June 6th, which is just a week away, right? We go down to put, and we want to buy Ford at $10. We think that's a fair price. And we're going to end up end up getting paid 5 cents for it. So, okay, there we go. 10,000 shares times, back there, times 0.05 equals $500. Okay, you just made $500 to wait to June 6th to hopefully buy Ford at $10. So it's $500. You just made $500 in about 2 minutes. Okay, so you end up waiting. And at this time, we said we were going to, in this scenario, we're going to end up getting those stocks put to us, meaning we'll end up buying them at 10. So we go to 10, then we can, and we want to put this, I'm very conservative and I don't really like to work. I want to go and sell this cover call option because I want my renter to be secure in their location, that they own the stock for a year. Come down here, 26, there's 25. And go down to June 26, right? It's a year away. Sometimes Yahoo just has a little glitch on their options. June 25. Now we're going to go down to June 26. Okay. Now we rent this stock out for a year, and I will receive $1.50 for it because I'm selling the option, because we sell and put bid price. And as we did that earlier, remember, we received $15,000 right away for it. So in a week, or June 6th, up until that point, we received $500 that we just had to have. We kept that $100,000 in the account, which we were going to do anyway. Then, so we kept $500. We got paid to do that. So it just went up that very small percentage. And then we went to, we're going to rent this stock out for $1.50 per share for a year. And that's an extra $15,000. So in total, in about a week, we made $15,500 on Ford to rent it out for 1 year. Okay. Then, as I discussed earlier, since we own the shares and we keep it, let's just say we rent it, the person who bought that option waits all the way to the end to buy that stock, we would end up getting all the dividends that year. So that's another 7%. If we wanted, I'm just going to use simple math. I know it's more complicated than this. So we have $500, right? So we go $500 for selling the cash secure put plus $15,000. So we made that in 1 week. Now, if we wait 1 year and we keep that option as good for a full year, and so since we own the shares, we get to collect the dividend. So let's clear this. And how much was our stock worth? Well, $100,000, right? Because we own 10,000 shares of a $10 stock, so we have $100,000. So yes, the stock's going to go up and down. I'm just going to use simple math here. So if we had $100,000, take that times 0.05, 7, because that's for 7%, what does that look like? $7,000. So we're taking a small stock, not small company, small stock price, utilizing this strategy to generate 7,000 plus 15,500 equals 22.5. You just made 22% 22% return on that stock in that year. What was the rate of inflation last year? You have what the government tells us, and then you have real interest or inflation. Depending on which number you get, one's nominally below 10%. The real number that I've heard is roughly around 15% for the last 4 years, every year. So if your stocks are not beating the inflation rate in the last 4 years of 15%, so each year is 15%, 15%, 15%. If you're not doing that, you're falling backwards. So you just made 22%. Going on from here, I think this is good. This is good, I think. I like the deal. But one thing about when we're talking about inflation, as an index, the only stock market in America that beat the rate of inflation last year was the NASDAQ, which is tech stocks. And those were led by 7 stocks. Out of the whole NASDAQ was held up by those 7 stocks, called the Mag 7. So, just by using this wheel strategy as a management style, we just generated 22% in a return in 1 year. And if I decided to sell those cover calls at more frequently and then keep reinvesting those dividends or keep reinvesting the premiums, we would get much better returns. So going in here real quick, risk and benefits. Consistent income from premiums, reduced cost basis over stocks, lowers the risk. You can read all this. Limits your downside risk because your cost basis keeps driving down. Limited upside potential. Yes, that is very true. Whatever the contract is, whatever you sell it for is the price. Whatever you sell that option, the cashier put, that's the price that you're going to buy it at. You have to always remember that. But if you always end up collecting, if you sell always over your cost basis, you're always going to be in money. So, stock selection criteria. Depending on what you like, but you want to know what you're investing in. If you think, oh, I've heard of Microsoft before, okay, invest in Microsoft. Some people just don't want to take the time to learn how to invest in a stock, but I came up with very simple rules on how to pick a stock. Is how long has it been in business? Is it profitable? Does it have income? Does it have dividends? It depends upon what you like to do, because some stocks are right for you, and other stocks may not be right for me. So I can tell you stocks that I like, but that doesn't mean they're right for you. Must have option liquidity. Okay. We can discuss that a little bit more, but really simple. Let me show you this. This is the options market right here for the Ford, as we looked earlier. Remember, we were selling, how many contracts we were selling? 10,000 shares is 10 contracts, right? Because you had to take 10 times 100, because each contract is good for 100. So at this time, there was 160 contracts available on the volume, right? Open interest is 5,000. If you're at the strike price and you want to sell at market, you're going to sell those options. So that's what liquidity is. Can you trade? If you own the whole market, that's the reason why you don't pick small stocks. And a lot of stocks don't even have options available. So you have to pick a stock that has options. Okay? Dividend yield. That's just the extra benefit if you have that. That's one of the benefits of being a long option seller. Most likely you could get those dividends because they're looking to buy that stock for that period of time. So there's different methodologies on how you have to think about that. We can discuss that later if you want to contact me about moderate volatility. We like volatility because that's what causes us to get premiums. Preparation steps. Very simple. Set up your account. Make sure you have the ability. You have to ask permission to trade options in your trading account. Your retirement account doesn't automatically have this. You may have to sit down and figure out how to do that. And I can help you with that. Just contact me and we can go through that. Stock selection. Pick a stock that you want that has options, preferably dividends. That means that you have some stability there. Execute the strategy, and then your risk. Now, I use this management style for all my stocks in my account. We've been talking about stock. I put this up there as of May 25th. Dividend yield, average monthly income 1 to 3%. So if you wanted to drive that, if you take that 15% that we talked about for the annual and you divide by 12, you're going to get above 1% a month. If you don't want to be started out really slow, use ETFs like SPY or other blue chip stocks. And you can use this for you can contact me for education. You can use YouTube, or you can keep watching the videos I put out. But I don't just focus on the wheel strategy because I talk about real estate and some other type of stuff too. Here's your tools. Yahoo Finance is free. ChatGPT is free. And then you can set spreadsheets up. I have my own that I use. If you want some, I can help you meet up with you and we can talk through it so you understand how the spreadsheet works. Experienced investors, they diversify across different sectors and they just use some stock screeners to figure out where the opportunities are. These are very simple. Again, give me a call if you want to talk about it. It's just like renting out a house. But there's a lot of things that you don't have to worry about when you just rent out your stock. I believe in having a very diversified portfolio, from stocks to real estate to cryptocurrencies. I like to be across all of those. And remember, I'm here for you. Just send me an email. You can scan my code and get my contact information there. Thanks for listening. Bye.